This podcast is sponsored by SoFi to help you get your money right and is for informational purposes only. Nothing in this program is a recommendation from SoFi to you or any listener. You should not rely on this program for any financial advice or legal or tax advice. The views expressed do not necessarily reflect the institutional views of SoFi or its affiliates.
This is the important part. I'm Liz Thomas, head of investment strategy at SoFi. Today, my guest is Brian Portnoy, author and founder of the learning platform Shaping Wealth. At the core of his ventures is the philosophy of embracing the emotions that surround finance and money, and learning to see them as strengths rather than obstacles to overcome. Shaping Wealth uses lessons from behavioral science and psychology to coach financial advisors on bringing a holistic approach to their client relationships that goes beyond just facts and numbers. He is also the author of 3 books, including The Investor's Paradox and The Geometry of Wealth. Prior to founding Shaping Wealth, Brian served as head of education for Magnetar Capital and was director of investment education and vice president at Virtus Investment Partners. Brian, welcome to the important part. I am super jazzed to have you here today. We're going to get in our feelings. We're going to get in our feelings about money. There are so many great topics to ask you about, but first of all, welcome aboard.
It's great to be here. I'm really happy.
So we all know, and everybody listening knows, no matter how much we want to deny it, money is emotional. It is a trigger for many people in many different ways. And in fact, an exact quote of yours is, money is an emotional lightning rod. Fear, anger, joy, hope, sadness, it all exists through money. And it drives anxiety for many of us in different ways, right? Different parts of it drive different types of anxiety. But even though we know it's true, we're not immune to it. Where would you say, just to kind of kick this off, where would you say people have the most uncontrollable emotional responses to money? And then also share with our listeners, because you're the expert on emotions and money, but I imagine you still are not perfect. Where are you emotional about money?
Everywhere and always,
Yeah.
because I am human. Well, I'll start with the big picture question you started out with, which is, I think money's most emotional when it taps into our survival instinct. So from a long-term, what does it mean to be human, evolutionary point of view, we do 2 things. We survive and we thrive. And for most of the human journey, survival was job number 1. We're kind of content these days. We've got food on the table and a roof over our head. But for most of the time that our brains were developing, we were sort of on edge and, needing to survive. And so sometimes the sort of, blood-stained mouth of the lion and the red lines on the graph are sort of indistinguishable. They're both threatening something in us. And so to your question, when do we become most emotional? It's when we feel scared. It's when fear is triggered. And, you quoted me to me, it really is this lightning rod. I mean, there's no emotion under the sun that isn't in some way related to our money lives. And I can tell you how emotional I am with money at times, but hopefully I've learned some things, but it's never easy.
Yeah. Well, and one of the things that I always try to remind people of is when we talk about risk on our side of the table, so from a professional investor standpoint or people that have been in this industry for a long time, we're usually talking about volatility. And volatility is really just how much does something stray from the average, right? And that can be upside volatility or downside volatility. But when an investor or when an end client hears the word risk, they typically define risk as losing money. So to your point about the red lines on a chart, as soon as those numbers are red, as soon as there's a red line, as soon as there's a red number on your statement, suddenly that's where risk comes into play and your whole mindset changes. So we hear a lot about how to remove emotions from the equation. How do we invest our money without emotion? This is why some people get a financial advisor. They want to have a little bit more arm's distance between themselves and the decision-making process. But you actually suggest that emotions can be useful. So maybe we shouldn't remove them entirely. They're a source of information, they're a source of motivation. So walk me through that a little bit, and maybe it'll help some of our listeners feel better about the fact that they are emotional about money instead of beating themselves up for it.
So there's a great line from a very good book in neuroscience called Descartes' Error. And the line is that we are not thinking creatures who feel, we are feeling creatures who think. And what I love about that quote is that it gives such a profound, powerful insight into who we are as human beings. There's no such thing as non-emotional, just as there's no such thing in physical space as non-gravity. You don't walk into a room and say, hey, how's the gravity in here? No, it's just always on. It's around. We naturally accommodate that physical force. Well, human behavior and emotion in particular is an always on force. It's 24/7. So the old line, and we go back, I spent a good chunk of my career on the investment side of things. And there was the mantra, hey, we got to take the emotions out of investing. It's the same thing as taking the gravity out of the room. It's just not a thing. Emotions are everywhere and always. They're always on. And so what we don't need is sort of a bit of a destructive mindset of let's get rid of emotions. Instead, let's lean into the emotions with emotional intelligence, with the right vocabulary. Then recognize, well, what is it that I'm feeling? What is this triggering in me? It's like when you go to the doctor and you say, I'm in pain. And she says, well, is it a sharp pain? Is it a dull pain? Upper body, lower body? I don't know. I'm in pain. Well, that's not going to be a very constructive dialogue. Same thing with emotions. The more that you can articulate how you're feeling, the more that you can see emotions as a source of intelligence. And in fact, modern neuroscience very much sees emotions as a deep well of sort of personal intelligence. You can bring that intelligence to how you react to the market, how you work with a financial advisor, how do you talk to your partner about financial goals. It's a bit of a mindset shift, and I'll admit it's not easy, but when you can use emotions as an intelligence tool, I think everything gets a little bit better.
Let's dig into that a little more, because you delineate a lot between emotions and emotional intelligence, and there is a difference. And I'm gonna
Yes.
guess here. You tell me if I'm wrong. Emotions are sort of involuntary. It just happens, right? It arises. You start to feel it. You have to have that awareness of what's going on right now. Why am I feeling this way? What got me to this place? And then the emotional intelligence can be more about, how do I react to it? How do I manage, right? How do I manage my own emotions in order to make better decisions? Is that close?
Yeah, it's close. It's one way of framing things that I think is actually quite constructive. So I'll quote Viktor Frankl, who wrote, I think, one of the most important books of the 20th century called Man's Search for Meaning.
Yeah.
He was a Holocaust survivor who then survived and went on to create an entire school of psychology known as logotherapy, sort of looking for the meaning in our lives. And I'm not going to quote it exactly, even though I should be able to. And he basically said that the gap between our stimulus and our response is where we find our freedom. And so you are correct. Things happened and we feel something. So, for example, we use emotional word wheels with the financial advisors that we coach so that you can lean into a more granular articulation of what it is that you're feeling, not because you want to express that anger or that happiness or jubilance in the moment, but just to be self-aware. But then to recognize I don't have to respond right away. You do find your freedom in that gap between stimulus and response. And emotional intelligence, which actually has 4 dimensions: self-awareness, self-regulation, empathy, and social skills. Self-awareness is the understanding what you're feeling. Self-regulation or self-motivation is having the ability to not react sometimes during difficult times.
Okay, so one of the most emotional things, I think, as an investor is comparing your own portfolio to anything else, right? Comparing it to your neighbor, or whatever your neighbor is telling you about what's happening in their portfolio. Comparing it to an index. That's the usual comparison. We're looking at the S&P 500, or we're looking at the NASDAQ and saying, okay, I'm up 10%, the index is up 15. I'm terrible at this. right? And it's that constant sort of feedback loop of comparing and whether or not you're measuring up to it. And I think that drives a lot of emotion from an investment standpoint, and sometimes can drive people to make really poor decisions. You end up chasing returns, or you end up selling something when it's down because you got scared. And there's another quote of yours, which is one from one of your books: beating the market. That's a silly and fruitless game. It's not tied to your real needs. It's attached to your ego. I'm going to take that as saying maybe we're setting the wrong expectations for ourselves as investors. But what are the expectations that we should be setting? What should we be comparing ourselves to, if anything?
So you are your own benchmark. I think there's good and sometimes hard work to define not just what you want to own and what you want to do, but who it is that you want to be, and then engage in a plan and a process to head in that correct direction. You know, there's an old line from JP Morgan, the original JP Morgan, when he said something like, nothing corrupts our financial judgment more than the sight of our neighbor getting rich.
Mm-hmm.
Well, now everybody's our neighbor in light of modern communications and social media. We can see everybody all the time. That wasn't true even a generation ago. Now everybody is, so to speak, our neighbor. And I think we're going a little bit nutty as a result. So it is hard. So you take hot trends like crypto investing, and boy, you know, it's up lately, and generally over a long period of time, it's up astronomically, and your neighbor or your cousin got in early to Bitcoin. It's hard to not let that impact not only your decisions, but how you feel about yourself.
Mm-hmm.
The best that we can do, in my opinion, is to breathe and take a moment and think about what's truly important to us. And then secondly, align our financial decision-making with those broader objectives. You know, it's what I've called in one of my books, funded contentment, the idea that true wealth is the ability to underwrite a life that's meaningful to you, however you choose to define it. And we start that process with the idea of contentment. What is important to you? And there's timeless, important sources of joy and meaning that that humans experience. And it's only after spending a little bit of time, maybe it's 2 minutes, maybe it's a walk in the woods, but whatever it is, maybe it's an hour with your financial advisor. But on the back of that exercise, ask, okay, well, what are the good financial decisions I need to make in order to underwrite or afford the things that are truly meaningful to me? And the better that you can do that, the more your neighbors, so to speak, disappear from the equation, right? They're no longer relevant because you're focused on what really matters.
Well, and I have to say, I mean, the stories that you hear, it's not to say that the stories are not true, right? When you go to a party and you hear about somebody who bought NVIDIA, I don't know, 5 years ago, and the price
Right.
has gone up tenfold since then. You don't know how much they bought. You don't know, you know what I mean? There are so many different details to it. And some of the stories that you hear are also, there's a lot of luck involved. And great for that person that maybe got into Bitcoin early or flipped houses for a colossal profit, you know, over the last 20 years or whatever the case may be. But comparing yourself to that and saying, oh my gosh, I shoulda, coulda, woulda, right? If I just had done it because I had that same idea for 10 minutes 5 years ago and I didn't do anything about it. It's that sort of mindset that you end up beating yourself up over, you know, why didn't I just pull the trigger? And now look at all this stuff that I missed out on. And then you open up your portfolio and have FOMO. And it's like, oh my God, well, now I'm so far behind because Mary across the street got in 5 years ago and I'm late to the game. So now I got to try to catch up. And it's that mentality of catching up that will get you in so much trouble because you end up taking way too much risk. What I want to hear from you too is when we think about emotions, I talked about this earlier in the interview, risk is defined by a lot of people as losing money. We're recording this on January 28th, which is the day after the news about DeepSeek from China came out. And
right. The AI game has changed.
The AI game, as of yesterday, changed. And we saw really sharp sell-offs in a number of different semiconductor names, a number of different tech names, because suddenly it was, oh my gosh, there's a new competitor in town, perhaps, and maybe we need to rethink this. So yesterday was a scary day for some investors, particularly investors who are overweight the AI theme, overweight those names in particular. So fear sort of took hold, and you could feel it as the market was trading. You could see these deep sell-offs. How do you talk to people about managing their emotions through a storm of volatility? Because it's not always something, and this is my opinion. You tell me if your opinion is totally different. Volatility is not always something that you should react to.
Hmm. Well, to the point that we were making earlier in terms of that space between stimulus and response, like there's no getting around the stimulus that we're going to get triggered. Now, hopefully you didn't buy Nvidia 3 trading days ago
Mhm.
and experienced nothing but downside. Presumably you've owned it for a little bit of time, and it's been on an epic historical run, so you probably have a little bit of profit banked. But the more important point is that, piggying back on what you've just said, sort of getting spooked by the volatility is one thing, being a little bit upset, but then acting on it is another thing.
Mhm.
So, if we're on a ship in a huge storm, it's really important to keep your eye on the horizon. And have you asked, well, what is your horizon? You use the example of Mary, buying Nvidia and getting rich. Like, well, was your benchmark all along to be as rich as Mary? Is your whole purpose here to keep up with her portfolio? It's a joke, but the answer is obviously no. And so, look, there's trading and there's investing. And I've written at length, a while back about the difference between the two. And, investing in my view, investing in the absence of a well-articulated financial plan is speculation. Now, that doesn't mean speculation is a bad thing. It just means that it's a different game and a different skill set that you should be prepared to play. And so if the health of your financial plan is anchoring on a one-day significant move in Nvidia,
Mm.
you might want to ask whether your financial plan is actually well situated. It might be a moment to step back and say, do I have this thing set up in the right way? Because if, massive, whatever the drop was, 15, 20%, I don't recall the exact, but the very large drop impacts your ability to afford your kids' education in 10 years or to retire in 20 years. Candidly, you don't have a well-designed financial plan.
Sure. Yeah. Too much concentration, perhaps. Okay, let's shift gears. You mentioned funded contentment. So let's talk about just money and happiness. And you talk about there being a difference between being rich and being wealthy. Let's start there. What do you mean by that?
Sure. I think there's a big fork in the road in our financial lives between being rich and being wealthy. And these are the ways that I define the term. So to me, rich is more. To be rich, to become rich, is to engage in the search for more. And in some ways, more is a good thing. We're hardwired neurologically, sort of from an evolutionary point of view, to want more, because if we're not competing, we're probably not surviving, let alone thriving. So we're hardwired for more. We have certain brain chemicals like dopamine that are sort of compelling us to move forward. At the same time, more is rarely satisfying. When we get more, well, what do we want then?
Mm.
More. And it's what psychologists call the hedonic treadmill, what Don Draper in Mad Men brilliantly comment on as saying that happiness is the feeling right before you want more happiness. There's no getting off of this merry-go-round. And that's just part of the human condition, but we should understand that that's not the entire picture. The other fork in the road is wealthy. And as I, alluded to quickly just a few moments ago, I think of true wealth as what I call funded contentment. This idea that we have the ability to underwrite a life that is meaningful to you, however you choose to define it, and however you choose to or are compelled to update that vision over the course of your lifetime. So one of my favorite social psychologists, Dan Gilbert, says that human beings are works in progress
Mm.
who mistakenly think they're finished. Liz, you and I, we're always evolving. We're changing. And this doesn't stop at retirement. It's not like at age 65, oh, I am who I am. No,
Yeah.
like this goes on toward the very end. We're always becoming that next vision of ourselves. And we're always grappling with, well, what is stable and real about me versus what are the parts that are adapting? This is just part of everyone's kind of quiet or even silent daily struggle. Well, this impacts the way we think about money and wealth. So when we think about funded contentment, we think about, well, what are the deep sources of meaning? To me, there are four. I mean, all models are wrong, but some are useful. I have a four-part model of contentment. I call it the four C's: connection, control, competence, and context. In other words, our sense of belonging, our sense of autonomy, our sense of mastery, and our sense of being connected to something bigger than ourselves. And those four things, to me, kind of cover the waterfront, and we can constructively, by ourselves, with our partner, with our family, with our financial advisor, work through those things. And by the way, they're going to change over time. What's important to you in your 20s might not be what's important to you in your 60s. We're works in progress who mistakenly think we're finished. On the back of asking those, I think, fascinating questions, we can then say, well, what does that mean for my spending, my saving, how I build my portfolio, what insurance I choose to buy, my charitable activities? It becomes very real and very granular. So when I talk about funded contentment, maybe it sounds poetic, and it is a little bit, but it's also grounded in real world, everyday financial decisions across the various dimensions of money life. To me, calibrating money and meaning is really sort of at the epicenter of true wealth. And some people do it well on their own. And I think some people who work with financial advisors might be able to do that as well.
Yeah. Well, and one of the things, and I think about this often, the word, even just the word happy. I mean, how often is anybody really actively happy? I mean, happiness to me is an emotion that's rather short lived. You have maybe a happy moment, right? Happy is an elevated sense of emotion, but content is really a longer term peacefulness. Right.
That's right.
And we're getting this. I told you we're going to get into our feelings today, but it's more sustainable. I think the idea of contentment is more sustainable than the idea of happiness, which I interpret as like elation and joy. And of course that's mixed in, but it's not a steady state of being. So I like that you talk about it as contentment. I'll add to that, wealthy does not equal content. And the definitions, and I think the idea, and society does this to us. You chase the word wealthy, you chase the word rich because you believe that once you get there, wherever there is, that you will be happier, you will be more content. You also talk about two different definitions of happiness, or two different definitions
Right.
of contentment. So there's the sort of here and now, the immediate happiness, and then the reflective or the deeper meaning of what that means. Walk us through that too, because I think this is a really important distinction, and I think it's something that might help people think through, what are my real goals with this? I mean, yes, we're using money as the conduit. It's a means to an end, perhaps, and we're talking about it in a measurable sense, but a lot of this from an emotional perspective is not measurable.
I'm really glad you brought this up. So, what I'd ask people to think about is two versions of happiness. Now, remember that word wheel I referenced before? When you start with the happiness wedge at the middle. Well, you fan out, and there's like 27 or 28 synonyms for happiness. Go to the thesaurus, and you'll find joy, elation, contentment, giddiness, whatever. There's a lot of words for happiness, but we're going to anchor on only two. And I think two is pretty manageable. One is experienced happiness, and one is reflective happiness, what we might call contentment. So experienced happiness, and I'm not denigrating experienced happiness. It's what we want every moment of every day. We want to be happy. You want to wake up in a good mood. You want to have a good experience with you. You want to have fun with your friend, or you want to go, you want to go on date night with your partner, or you want to have a good time at work, or whatever the case. You want to be happy. Keep in mind the Don Draper quote, how happiness is the feeling right before you want more happiness. So you're exactly right. It's short-lived. It's ephemeral. It comes and goes. And that's that treadmill, which you can sort of lean into. It's not necessarily a bad thing. I go on the treadmill every now and then to stay in shape. So we can be on that treadmill, and that's just fine. The other direction is reflective happiness. It's what I call the step back. Now, it forces us to get into our heads a little bit. And, our brains are gas guzzlers. They're about 2.5% of our body weight, but they spend 25% of our calories. So our brain is fine tuned to not think very much. That's why Danny Kahneman wrote a book called Thinking Fast and Slow. We're usually thinking fast. It's like on auto drive, right? You know his work intimately.
Yeah.
So with reflective happiness, we're leaning in, we're thinking, we're asking ourselves question. How do I feel? How do I feel about my life right now? Am I living the life that I want? Well, number one, it's physically exhausting to do that. Number two, you become quite a bore, especially at parties. You're not going to be sitting around talking to people about the meaning of life at every moment. But it is useful every now and then to step back and ask those questions. What's really interesting, I think, for our conversation and probably for your listeners is that the question of does money buy happiness, the answer varies depending on whether you're talking about experienced happiness versus reflective happiness.
Okay. Do you believe in budgeting? That seems like a question sort of out of left field. But if we're talking about financial goals and I'm thinking about tools that an advisor or anybody giving financial advice might tell someone, how do you get on the right path toward achieving your goals? I imagine something like budgeting is part of that process, and then setting your goals. So number one, do you believe in budgeting? And number two, what's an example of a healthy financial goal for somebody to set?
Okay, two big questions. So I believe that budgeting is good for some people, but not for others. For some people, it is a source of liberation. For others, it is a set of chains that weigh them down. And there's a bit of a know thyself. So in the realm of, hey, this might not be for me, I like to think of kind of an anti-budget in the sense of, hey, I have a pretty decent sense that I can spend X number of dollars per month and stay on track and not go into debt. And where that money goes exactly, well, it's going to be time consuming. It's going to be a heavy cognitive load. It's going to be annoying and exhausting to keep track of it. But as long as I'm sort of in the ballpark of not overspending whatever that pool of capital is, then you're in pretty good shape. So that's sort of an anti-budgeting kind of mindset. Others, they need the rigor and they need the discipline. It can be hard to do. And there's just particular types of personalities, I think, whether you're on your own or working with a financial advisor, where spelling out ahead of time, this is what is possible, this is what you've done. But I don't think there's one top-down perfect answer to that question. So it's not a question of whether I believe in budgeting. I think that there are different types of budgeting tools or mindsets available to us. And there's some trial and experiment and error that we can go through to figure out what is the right way for us.
Okay. And what's an example of a healthy financial goal?
A healthy financial goal. I mean, there's goals and then there's purpose. So we like to talk a lot in the financial advice space about goals-based wealth management. Let's just think about retirement. There will come a point at which you want to either stop working or work less or change roles. And that's not only healthy, that's just really normal. I mean, retirement was a social institution invented in the mid 19th century Europe. But before that, like, retirement wasn't a thing. You just worked until you died or until your family could take care of you. The state didn't really get involved with pensions and all that until relatively recently. And so retirement is a healthy goal in the sense that we know we're going to slow down at some point. We're going to be compelled to, just based on our physical health. And so, well, what does our ideal retirement look like? And how do you plan for that from an investment point of view, from a saving and spending point of view, in terms of your human capital and what your income is? There's a lot of different inputs to that, obviously. So it's sort of like the most obvious answer, but sort of a well-constructed retirement is an incredibly healthy goal. I would go one level below that, though, in terms of what really precedes goals. So there's goals, that's the what, and then the plan is the how. But before we get to what, we want to start with why. Why is it that you want to retire at age 65 with X million of dollars so that at a 4% withdrawal rate, you can, you do the math and you come up with a pretty effective, simple financial, plan for retirement. But why 65? Why $2 million? There's a lot of questions behind that. And that's where you come back to the 4 sources of contentment that I talked about. Those can begin to tap into your why. So the biggest one is our sense of belonging and connection to others. It's being around our loved ones. So if what we know from an enormous body of research that the number one source of deep contentment in human life is the quality of our relationships, then a truly, truly healthy goal is to be in good relationships now, soon, later, and forever. So if you're thinking about if you're in your 30s or 40s or 50s or 60s and you're leaning into the back third of life in your 50s or 60s or 70s, beginning to think now, not in 20 years, about the relationships that are going to bring you joy toward the very end, that's the healthiest of goals. There's the other, sources of contentment, our sense of autonomy or freedom, mastery. Work is very important to us, Liz, just not in the obvious sense of, okay, it's something to do so that I can pay the bills. Work is a source of our identity. When we go to a party, someone says, hey, what do you do? Spoiler alert, they couldn't care less what you do. What they want to know is something about your identity. They want to know something about you that's truly meaningful. And so we see actually elevated levels of depression, especially in men post-retirement who have lost a good sense of their identity because it was so wrapped up with work. And then the fourth C, context, which I haven't really explained at all, but I think it's important, and talk about a healthy goal. Humans are content when they feel connected to something bigger than themselves. And the deep sources of that context or that purpose over the millennia have been faith and place, religion, spirituality, faith, and then your hometown pride, your patriotism, your sense that you belong somewhere specifically, geographically, anticipating that those are going to be important to you. So whether it's, participating in your church or leaning into supporting your hometown in one way or another, and having the financial means of doing that, whether it's participating or whether it's giving or underwriting a particular program or something, those are very healthy goals that are quite achievable.
Yeah. Yeah, I'm so glad that you brought that up. I actually just had this conversation with my husband a couple days ago about the idea of retirement and the negative effect that it has on a lot of people's psyches. And I'm going to tie together the last two pieces that you talked about. I think also not only does work give you an identity in a lot of ways, it gives you purpose. And you lose that purpose if you don't find it somewhere else or build it somewhere else in life. You end up sort of like a rudderless ship. You retire and it's like, what should I do now? And what is my purpose here, right? And the other thing about the identity of work, I think societal pressure tells you, well, you shouldn't only identify as whatever your profession is. That means that you don't have enough meaning in your life otherwise. And I'll go even further to say, I think for women, that's even harder because society tells you that you're supposed to identify and have purpose in different ways. And if you identify too much professionally, you start to get a little critical of yourself. Why am I feeling that? There's so many different aspects of this that are fascinating that I think people struggle with on a daily basis. I mean, I've struggled with it before. I find a great amount of identity in the work that I do. And I have a lot of friends who are full-time professional women. They find a lot of identity in it as well. But you end up with that natural societal struggle of, but am I identifying too much with my job? Have I become a workaholic, right? You leap into these sort of labels of yourself. So I'm glad that you brought that up.
Yeah, I just amplify that because I do think it's so important. Identity, the I word, it's a little bit of a political hot potato, identity politics, something that no one really wants to get into. And we think of that as this monolith. But when you, I think, more constructively think about the idea of identity, you quickly realize that each of us has many identities and they are important. And it is more threatening to someone to challenge their identity than to challenge a belief, let alone a possession of theirs. So I have multiple identities. I'm a husband and a father and a business owner and a Steelers fan and a dog owner and a Chicagoan and an American. And I have dozens of different identities. And my walk through life every day is reinforcing or undermining elements of those identities. And the nice thing is we have agency. We have choice to think about the identities that are most important to us and the ones that we really want to underwrite. And so whether it's, women feeling pressure to do it all and to be all, to work, to raise kids, to support the community, for the man in a traditional sense to be the breadwinner. And when he no longer works, he's not worth as much anymore to society. The good thing is there's an opportunity to take time to think about not just what you want to do or what you want to have, but who you want to be. I sometimes say it's not humans doing or humans having, it's humans being. And so what does it mean for you to be in the identities that are most important to you? And God, it feels like we're pretty far away from NVIDIA's 15% drop yesterday. In my view, we're right next door, because these questions about purpose and identity connect so clearly and closely to money. It's pretty amazing to me.
Yeah. Wow. Okay. So I had a question that I was going to ask you. When you give financial advice, what do you do differently from other financial experts? But I think it's clear at this point. I think it's pretty clear what you do differently, and just wrapping in all of the emotional side of it. So I'll move on to something else. I think a lot of people feel really overwhelmed when they might hear this podcast, for example, and say, okay, I need to rethink my financial goals. I need to rethink the way that I think about money, because you know what? He's right. And this is really resonating, and I'm stressing myself out over a bunch of stuff that is just not meaningful. But then I think people get really overwhelmed, because it's like, well, how do I do that? Where do I start? How do I reorganize, right? And I can maybe look at my portfolio or look at my accounts and understand that I'm too wrapped up in this. But what's the first step, right? What's the first step in getting more healthy about our financial well-being?
The first step is not the money step. The first step is the focus on you and what's important to you. So I've used the term contentment, which I think it sounds like it's a word that you like as well.
Mm-hmm.
But, we could come at it from different, with different vocabulary. What do you really believe in? What are your values? What's important to you? What do you have the sense brings you happy, deeper happiness or contentment? Having nothing to do with the stock market or your budget or your whole life policy or anything else like that. Take the time to even write on a piece of paper, these are the things that are most important to me. And when I think about what I want to do in the future, and then when you imagine your future self and the legacy that you want to leave, what are those most important things? What do you imagine they're going to be? We can't predict perfectly, but you can take a good guess. And so you start there. And this might sound like a long ways away from money world, but again, it is actually the first step to have a healthy relationship with money world. And so once you've gone through that exercise, and by the way, you don't need to write a novel. You don't really need to write a full autobiography. You just need to maybe on a walk, not listen to a podcast and just talk to yourself. Just think. And then ask yourself, okay, how is my financial life situated in a way that's going to allow me to live my values, pursue my beliefs, underwrite my identity, however you choose to frame it? There's lots of different ways that we can frame it. And one of the mistakes that I think people make generally, and it's sort of been a pivot in my 25 plus year career in the industry, is that we focus so much on the investment piece. That the markets are so captivating and they're fascinating. And there is an element of, wow, I can make a lot of money quickly if I make the right choices here. There's nothing wrong with feeling that way. A lot of people feel that way. I feel that way sometimes too. But there is the investing piece, but there's how do you save? How do you spend? How do you protect yourself and manage risk? How do you think about your charitable giving? How do you think about borrowing? There's a lot of different dimensions of money life. And if you focus just on the investing piece, you're going to lose the richness of your money life. And a lot of stuff's going to fall through the cracks. And you're going to tee yourself up for failure, because you're going to see that Mary bought NVIDIA 5 years ago and she's now driving a Lamborghini. And you're like, wait a minute, where's my Lambo? Like, you ain't getting one because you just didn't do what she did, which, by the way, was probably a lot more luck than it was skill.
Right. Oh, Mary. Mary's haunting us now. All right, let's
finish.
You
used her name.
I know, I did. I made this fictitious character. Let's finish on a fun technology front. You have a tool that you use in your coaching business, an AI tool, and her name is Lydia.
Her name is Lydia.
Tell us about Lydia. What does Lydia do, and how popular is she?
Lydia is a newborn. So I don't know how popular she is, but I think she's got potential. First of all, I'll give you one line on the name because it's kind of fun. So money was invented in what is modern day Turkey, what was then the Empire of Lydia, about 2,700 years ago. So the very first coin ever discovered was the Lydian coin. And so I wanted to name this project with our AI partners about on the human journey of money, the human experience of money going back 3,000 years. So that's why it's called Lydia. And Lydia is actually built for the wealth management industry. It's not what I'd call a retail product. It's available and being built for the global financial advice space. And it's an always on, high IQ, very empathic companion with whom you can talk about your clients and prepare for meetings. It can do live role playing. Hey, I'm meeting with Mary and Jim later today to talk about this sticky retirement issue. Hey, Lydia, can we go back and forth on this? Absolutely. Firms from a top-down point of view can plug their CRMs into this, so you get enormous amounts of client data. You can even, in its fullest expression, have it analyze your entire client base and say, if you're running a big firm, if you've got hundreds of advisors at your firm, it can process an unlimited amount of unstructured data. So you can say, Lydia, what's the team been talking about? Tell me the top 5 conversations that we had in calendar year 2024. Oh, that's interesting. Oh, can you actually write a blog on each of those every month for the following year? Can we do some other client-facing work that really helps clients better understand the decisions that they need to make? So bottom line with Lydia is that a lot of AI and financial technology, fintech, it's about efficiency. Lydia is about effectiveness. Lydia is about making a difference in people's lives. It's efficacy. It's helping people achieve funded contentment. And so it's about augmenting human brilliance. It's about augmenting our capacity. It's not about replacing us. And I think that makes it a relatively distinguished offering in the market.
Yeah, I mean, if it's able to have a human element, right, or understand human emotion or an empathy element, I think that would be a big distinguishing factor. Okay, this has been incredible. Thank you so much. I mean, I feel like I need to go back and rethink my my financial plan. So we've got some quick segments that we like to finish the pod
Sure.
on. The first segment is called The Word. So just one word here. This is one word answer. In one word, what's the most important way to think about emotions when investing?
Healthy.
Healthy. And you know what? I think that is going to end up being one of the biggest takeaways of this episode is that instead of trying to avoid them and subtract them from the equation, let's figure out a way to use them to our advantage.
Can I jump in and just say, imagine anyone listening, if they've heard the whole thing, imagine walking into a room and saying, I'm going to take the gravity out of the room so that I can have a clear space. It's the same thing with your emotions. You cannot remove them.
Right. Well, you could go to outer space and remove the gravity. Right. But
there's no emotions in outer space too, I'm told.
Yeah. So if you want to solve all the problems, just go to outer space. Okay. The next segment, the aha moment. What made you realize there was a gap in the market for this kind of wisdom and education?
I had a literal aha, saw the light bulb over my head in 2011 when I read a book called The Art of Choosing. It's not a finance book, but it is in this field of social psychology, how humans make decisions by themselves and with each other, and written by a brilliant scholar named Sheena Iyengar. And it is both scientifically grounded, but at the same time, a beautiful meditation on what choice and agency and freedom truly means at a deep psychological, even neuroscientific level. And Liz, I had been in the hedge fund industry for a decade, moving around relatively large pools of money with my colleagues, investing in complex investments, been there, done that. It's been great. However, it was that book at that moment that let me know there is a massive space to create value for investors, giving them insight into what really makes us human and how we make better decisions.
Yeah, I love that. All right, the last one. You get to choose here if you want to paint yourself in a in a positive light or a negative light. It's either your best or worst trade. What's been the best or worst investment you've made for an emotional reason?
I'm much more comfortable talking about my terrible investments. And I was the director of research at a quite large fund of hedge funds for a while. And I led the research, which I'll put in quotes, air quotes, because it was pretty lame. But I led the research on a newly launched hedge fund that was raising billions of dollars of capital from some of the biggest names in the industry, which I won't name, but people would know these names. And my firm was kind of in the front row having an opportunity to do the same. I was caught up in the competitive nature. Oh, these other big firms, they've got access. We've got access too. I spent a lot, probably too much time with the lead portfolio manager, who was a billionaire. And we had some nice meals, and we had deep conversations about markets and investing and philosophy. He's no dummy. But I really got sucked into the story, and I think I took my eye off the ball on certain risk management topics. And 2008 came, and granted, a lot of people did poorly in 2008, but he did an order of magnitude worse than we would have expected. And I think that if I had done not just better intellectual due diligence, but if I had sort of created that space between stimulus and response and not leaned in like I did, I would have saved our investors probably $100 million.
Wow. Wow. Yeah,
It was terrible.
I can feel the pain in your story. It's a tough lesson to learn, but you know what? You learn it fast when it happens, and you look back on
Haven't
it.
made it again.
Right, exactly. And you do that sort of spilled milk analysis of what did I miss? And then you realize that maybe some of the stuff you missed was more obvious than you thought. And I'll give you a little bit of a pass here, because if it was during the time leading up to 2008, that was a time of an element of euphoria that was going on in markets. And most investors started to make bad decisions. Most investors turned a blind eye to some of the risk metrics that they would have normally abided by. So I think, you're not alone. I know you're not alone in that sort of psychological warfare that many of us went through at that time.
I appreciate that. Yeah, 06, 07 was a pretty heady time. But the term OPM, other people's money. When other people's money is involved and you make mistakes, it hurts really bad. I've made some crappy trades on my own, and kind of stinks. But the damage is limited to the family portfolio. It's really, for anybody listening who is in the money management space, losing other people's money to me feels 10 times as worse as losing my own.
Yeah. Mary would be coming to you asking for her money back.
Mary's fine. Mary's been long in video for 10 years.
Mary's good. She can sell her Lambo. She'll be just fine. Yeah. Okay.
Yeah.
Brian, thank you so much. This was wonderful. And I know that people are going to find this really helpful. So thank you so much for sharing all of your wisdom with us. And you've got 3 books. Is that right? 3 books that are out?
3 books. 3 books.
So everybody should go look for those and get some of this wisdom to keep at your fingertips, because I think it is invaluable for every investor, for anybody who has a financial life, period, which is all humans. So I think it's really important to keep a lot of this in mind. So thank you very, very much for joining me today.
My pleasure. It was great. Thank you.
I hope that everybody got as much out of that as they could, because that was a wealth of knowledge about trying to manage your emotions, your emotional response. And what he talks about is the space between basically being stimulated and responding. I think it was invaluable information for any investor, for anybody who's trying to get their finances right. The first concept that he really discussed was the fact that money is the most emotional when it taps into our survival instinct, and most importantly, when it taps into our fear instinct. And that's why it ends up as a trigger for so many people. So then what are the big takeaways there? How do we manage that? Because we know that that's going to happen no matter what. It's going to happen for different reasons, for different people. Everybody has their own triggers, but there will inevitably come points in your life when you have the fear trigger about money. I thought one of the best points that he made was that rather than trying to take emotions out of it and pretend that we don't have them, or find some way to avoid the emotion of investing or avoid the emotion of money, lean into it and recognize that it is going to happen, that there are going to be things that trigger you, the more you can articulate what those things are, the more you will actually understand about perhaps your own financial goals. And you can use your emotions as information, maybe even motivation to stay on track for your goals. And I think that's a great overarching concept. One of the other big takeaways that I had was his idea of the difference between being rich and being wealthy and what you're chasing when you're talking about both of those things, and defining rich as the search for more, this constant search for more. And he even linked it to happiness, where happiness is the emotion that you feel before you just want more happiness. So it's this never satisfied state of being, where being wealthy is maybe not even a measurable goal. It's not necessarily a money goal. It's about what's really important to you as a person and what's important to you to achieve by way of your financial plan. So I think also just kind of switching that mindset and searching for what he calls funded contentment rather than riches is also really important. And then the next thing I would highlight, and perhaps the biggest thing from a more applicable standpoint, you are your own benchmark. So rather than doing what I think we naturally do, which is compare ourselves to our friend, compare ourselves to the story that we just heard from our neighbor next door or somebody at a party, or compare ourselves to the broad market index, you should compare yourself to yourself. What do you want to own? Who do you want to be? What are your goals? And if you can manage to focus more on that versus comparing yourself to all of these external factors that may or may not even be right for you, all of that becomes less important, and you stop being clouded with this view of chasing the next best thing or trying to keep up with whatever you've decided this external comparison is. So I think that was also a really, really important step to managing your money with a more level head and more emotional intelligence than just responding to emotions in the moment. So thank you very much for listening, and we look forward to bringing you the next episode very soon. For more from me, read my weekly column every Thursday on the SoFi blog, or follow me on X at Liz Thomas Strat. Follow The Important Part wherever you get your podcasts. The Important Part is produced by SoFi in partnership with Pod People.
This episode of The Important Part was recorded on January 28th, 2025. The views expressed do not necessarily reflect the institutional views of SoFi or its affiliates. This program should not be copied, distributed, published, or reproduced in whole or in part or disclosed by any recipient to any other person without the express written consent of SoFi. Each name of any organization mentioned in this program is the property of the company to which it relates, is used here strictly for informational and identification purposes only, and is not used to imply any authority, ownership, or license rights between any such company and SoFi. The content of this program is not a recommendation from SoFi to you or any listener or recipient of this program, and is provided for informational purposes only. SoFi is not providing any financial, economic, legal, investment, accounting, or tax advice through this program, or to its recipient, and you and any person should not rely on this program for any advice. Investment decisions should be based on specific financial needs, goals, and risk appetite. SoFi has no obligation to provide updates or changes to the information in this program. Past performance of any investments mentioned does not guarantee future results, which may vary. Neither SoFi nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information contained in this program. Any liability for any statements in this program is expressly disclaimed by SoFi. For additional disclosures related to the SoFi Invest platforms described above, please visit sofi.com/legal.